Hello everyone, and welcome to ACCA taxation paper. In this paper, we're going to look at the BPP textbook, and we're going to look at chapter number 1 today, and we're going to look at the introduction to the UK taxation system. In chapter 1, we don't have many things, very basic things, introduction to the UK taxation system. So let's look at the chapter overview, what you have here, and we're going to cover. So you can see here is a chapter overview, purpose of the taxation in the modern economy, so structure of the UK taxation, and type of tax. Now, this is important a little bit. So type of tax, we have a direct tax and we have an indirect tax. So let's find the difference between these two, direct tax and the indirect tax. So direct tax is deducted at source. So tax deduct at source. So tax deduct at source. That means we don't have any choice. The tax will be deducted before I receive my earnings. So for example, if I'm an employee, before I receive my salary, the PAYE tax is already deducted. It's not me, I have decided to pay myself. So my employer, the company, will already deduct this tax from my salary, and after that, they give me the net pay to my bank. So that means they already deduct the salary, the tax from my salary, and after that, they give me my earnings. So whatever tax is deducted at source, that means from where I'm getting the money, if they deduct the tax already from there, is called direct tax. On the other hand, we have an indirect tax, and in other form, we can call it as a VAT. So the indirect tax means they will not deduct this tax from my salary straight away, but they will give it to me. And when I'm going to spend this money everywhere, for example, in the supermarket or in the restaurant, or to pay the bills, for example, gas, electricity, or rent, and I have to pay the VAT for that. So basically, the money is already with me, but I have to pay from there, from this money, additional 20%. For example, if the service is £100, I have to pay £120 because 20% will be the VAT. So this one, I'm paying myself. And the other one, the direct tax, they already deducted from my salary. That's the difference. So if the tax is deducted at source, we call it direct tax. And if I receive the money and after that I pay the tax, because every time I'm going to spend, they'll charge me 20% of VAT. That's called indirect tax. In the other form, we can call it VAT, is the same thing. Then we have taxes in the UK. So taxes in the UK, we have so many types of tax. We're going to look at one by one. The next one is important one we have here. That's tax avoidance and tax evasion. Now, tax avoidance, nowadays we don't call it tax avoidance. Nowadays we call it tax planning. Tax planning. Tax planning means it's a sensitive way to save the tax. For example, when a person come to the accountant and say like, this is my business, this is my property, I have some sort of share or dividend. So what is the best way to save some tax? So you tell the rules, the guideline from the HMRC, so that the person can save some tax, or it will be best for that person to utilization his money. For example, if the person don't know if he's married, he can claim the marriage allowance. So you tell them, listen, if you are married, then you will have some tax savings. For example, if the person don't know, he can take some dividend, for example, £2,000 without any tax, and he's a director of a company. So you tell them, listen, if you're a director, you can take £2,000 without any tax. For example, if the person don't know, if he's a basic rate taxpayer, he can have a different sort of advantage. For example, the nil rate band for the savings income. So you can explain to them. You can tell them like, listen, if you are a basic rate taxpayer, or if your income is more than 100,000, why not you give some charity, or why not you give some gift aid like a donation, or why not you are giving some contribution on the PPC, that is personal pension contribution, so that you can save some tax. rather than you pay more tax because your income is more, because you already know if our net income is more than 100,000, so our personal allowance will be reduced. For example, if someone income is 110,000, so his personal allowance will be half. For the 10,000, he will lose another 5,000 personal allowance. So as an accountant, you can say like, listen, your income is more than 100,000. Why not you just like pay 5,000 on the charity or on the personal pension contribution or on the gifted donation that will extend your basic band and you will pay less tax. So this sort of thing, for example, if a client come to you or business come to you like, I like to register for the VAT, what will be the best for me? Now you can tell them like, listen, based on your company, the way you have the business, for example, if you have a takeaway, if you're an accountant, I can see the flat rate is 10% or the 12% is a flat rate. And you need to explain what is flat rate because the client don't know. You can tell them like, rather than you register with a standard rate VAT that is 20%, why not you register for the flat rate? You pay only 10%. And you have to explain that. So basically, you're telling the rules and the regulation, and this is the legal way you tell your client so that he can save some tax. So this is called tax planning. Now, tax avoidance is basically try to avoid the tax, and it is legal, but sometimes you called it unethical. So it is illegal, the tax avoidance, but we sometimes called it unethical. Why we called it unethical? Because sometimes some accountant, they called it window dressing. Sometimes some accountant called it creative accounting. That means you try to show the picture in a different way so that the profit can be high, profit can be low, or for example, the expense can be low, expense can be less. For example, let's say if you have a closing inventory and you use the FIFO method. So if you use the FIFO method, normally your closing inventory, the value will be high because the closing inventory will be multiplied with the higher rate. And if the closing inventory is high, that means your total cost of sales will be less because the way we calculate the cost of sales, that is opening inventory plus purchase and less closing inventory. So if I take away a lot of closing inventory, my cost of sales would be less. And if the cost of sales is less, my gross profit will be high. So that means if the client tell you, listen, I am looking for some big loan from the bank, can you make my profit higher? So you do a little bit creative accounting so that the accounts looks nice. Maybe you claim a less depreciation on that year or maybe more depreciation on that year. So you try to display the account the way you want. And it is all a legal way, it's not illegal. And you try to take the advantage of your thing. If you do that, we call it tax avoidance. You try to take the advantage, you try to use the rules of the tax. For example, sometimes we see like different people, even living in the UK, they have millions of pounds and they don't pay any tax because they're not domiciled here. So they're resident here, but they're not domiciled. Now, if you don't born here, then you are not domiciled by born. Or then you have option, you can be a domicile by choice if you want, or if you don't want, you can select, okay, I'm domiciled in Bangladesh, I'm domiciled in India, I'm domiciled in USA, wherever you from. So in this case, you don't pay any tax until it is applicable to you. So there is a lot of way people try to save some tax, and the reason is like it is legal and the law allow them to do it, and we call it tax avoidance. And sometimes we call it is not ethical because if you live here forever, this is your business here, so why you are not paying the tax? Because you don't want to be domiciled here, by intentionally because you don't want to pay the tax. On the other hand, we have a tax avoidance. The tax avoidance is all about when you try to save the tax and you try to hide some information either, or you give the false information to HMRC. For example, let's say you have a sales just the last day of the tax year. For example, your year is ended 31st of July. And just day before, let's say 30th of July, you have a millions of sale. And you don't want to show it in this year because let's say your sales is already high this year. And you're thinking like, okay, I don't want to pay tax this year. So rather than sending the invoice on 30th of July, you send the invoice on 1st of August after 1 or 2 days, so that it goes to the next accounting period. So it will be calculated on the next year. Now, what happened because of that? Maybe you don't pay tax in this year, and also maybe you will not be on the threshold for the VAT registration, or you're trying to take some advantage, just giving the wrong information to HMRC. If you do that, it's called tax evasion. Tax evasion is not legal, it is illegal. So basically, tax evasion is not allowed, and sometimes you try to give the wrong information or mislead HMRC intentionally. This comes under the tax evasion. But nowadays, when you try to save some tax, giving some advice to the client, we call them tax planning. All right, so then we have some few more things. For example, we have a double taxation agreement here. It is when you have a income from different country. For example, if you are from USA, and let's say you have a income in USA and you have income in UK as well. So what happened if you pay some tax already in USA? You have some income and you try to bring this money in UK because you live here, and if they ask you to pay the tax again here, so you can say, listen, I have some property in USA and I already pay tax there. So let's say, for example, you already pay £5,000 tax in USA, and UK they calculated £6,000 tax. Then HMRC will tell you, listen, based on your income, you should pay £6,000 tax in UK to HMRC, but you already paid 5,000 over there. So we minus 5,000, you just need to pay 1,000. This is called double tax territory. So almost every country, they have this agreement. Most of the country, I cannot say the whole world, but most of the country, they have a double tax territory agreement with United Kingdom. And nowadays, few countries, almost like 100 countries, they become together. They are sharing the information for the common tax purpose. So for example, if we have an income in any other country, for example, Mexico, or for example, France, or Sweden, or Ireland, they will able to find it out. Do you have an income there? Before, so many people, they did not declare their income that is overseas. They have some property, they rent it out. They didn't tell in HMRC they have income from other country because they never bring this money from there to here. But now they are together, so all the country become together. So HMRC will be able to search you by your name and date of birth. They can see, like, is there any income you have on overseas, and they'll put a tax on that. By law, you have to declare all of your income in HMRC, even though you don't have to pay any tax, but still you have to declare. All right, so let's have a look what you have in the chapter. I think that's all we're going to see. The most important thing, direct tax, indirect tax, we have discussed that. Then okay, so we have one more information here. We have a tax year and the financial year. Now, the tax year is basically for the individual. For example, if you're a self-employed, if you're a sole trader, then you have a tax year. And normally the tax year is 6th April to 5th April. So for example, tax year 2022 and 23 start from 6th April and finish on 5th April. Every year, 6th to 5th, 6th to 5th. The way we run the PAYE and we pay the tax exactly same way. For example, 6th April to 5th of May, it is our month number 1. So the first PAYE will be calculated from 6th April to 5th of May. So if you're working on the finance department, you should know this thing. But if you work in future, you'll know this thing, how does it work. And the P32 report will tell you how the PAYE tax calculated, how it is adjusted with any statutory deduction, for example, maternity, paternity, or student loan, how it adjusted. You're going to look at everything from the P32 report if you work on especially on the payroll section. Then we have a financial year. Financial year basically for the company, and it's from 1st April to 31st of March. Because when you are a company, you don't basically look at like only 6 days. For example, if you calculate the tax, you don't have to look at like, oh, I have a 6 days from the April, and 5th of April I have to finish, and 6th of April I have to start. Doesn't work. For the company, it is 1st April to 31st of March. And the financial year is run every year. Now remember that financial year and the accounting year Accounting year is not same thing. So accounting year, or the period of account, basically the period of the business. It is possible the business can start anytime. For example, you decided to start your business on January, and your year will be ended on December. Now, for example, if it is in 2023 or 24, now you can see from January to March, we'll have one financial year, 31st of March, and from April to December, have another financial year. So for that reason, when we submit our tax return to HMRC, you'll see there is always two part, because it is possible the government can change for the 2023, the corporation tax may be 19%, but in 2024, the corporation tax can be 20% or 25%. For that reason, one accounting year can be divided into two financial years. When you will be working as an accountant or on the finance department, when you prepare the accounts for the limited company, you're going to see it, and you will see like all the accounting year is divided into two financial years, because not every company started or follow the same financial year. But so many companies, they start anytime, and after 1 year, they change the accounting year and they try to match with the financial year so that they don't have to do the breakdown. All right, so the next one we have here, I think the next important one we have one activity. Let's have a look. It's activity 1, tax avoidance or tax evasion. Let's have a look. What is it? The following acts have been committed in the course of business of one of your clients. Action 1, a customer invoice was omitted from accounting record in order to push it into the taxable profit of the following tax year. Now you see is omitted intentionally. It didn't say by mistake. Intentionally, he omitted, he didn't record it. He left one invoice like somewhere, like, okay, I'm not going to show this sale this year. Why? Because I want to push the profit, the taxable profit, to the next year. So I want to show it in the next year. I don't want to show too much profit this year. I don't want to pay too much tax this year. As I gave example before, I just want to record this invoice next year. It's not like I'm not going to show, but I'll show in next year, because as you know, when you issue the invoice, we have 30 days to make the payment by the customer. So let's say rather than issuing today, I can issue tomorrow. So for that reason, if you do that, is a tax evasion. It's not legal. Remember that. If you do it intentionally with the intention, like I don't want to pay the tax this year, I don't want to make the profit this year, I want to show next year, it is not legal. And obviously it's a tax evasion, because you're giving the wrong information, or you're misleading the information to HMRC. The next one is action 2. The client decided to gift an asset to their spouse in order to reduce the capital gain tax. So it's definitely is a good thing to do. We always advise to our client to do that. So for example, if the client come to you and say like, we have a house, we have a painting, we have a car, and we said give a gift so that you pay less capital gain tax because your wife don't have an income, give it to the wife, because between the wife and husband, it is exempted, is a zero rated, so you don't have to pay any tax if you give it to your wife. So give it to your wife, and when your wife sell it, and she will pay only 10% capital gain tax because she don't have any other income. But you have a more income, so you are the higher rate taxpayer, you pay 20%. So we can give this advice, it's not a problem, it's a tax planning. So there is no restriction for that. You can always give the advice that saves some tax for your client. Which of this action amounts to a tax evasion? So which one is a tax evasion? The first one, because we are hiding on invoice, we don't want to show an invoice this year because we don't want to pay the tax, or we don't want to show, we want to make more profit on the next year. So in order to push it into the taxable profit of the following tax year. All right. So which one is the tax evasion? The action 1 only. Because the action 2 definitely is a tax planning. So the action 1 is the only one. I'm misleading the information to HMRC. All right, so what else we have here? And then we have some introduction. with other jurisdiction, double tax agreement. I think you can read it. It's not very important, but you can read it anyway. And this is the chapter summary. So you don't have much thing in chapter number 1. So hopefully what we discuss, it makes sense, you understand it, and it will be helpful for you to understand what I explained to you. If you remember that, then will be applicable maybe for the future chapter as well. Always try to read this thing at the knowledge diagnostics on the end of the chapter. It will always give you some understanding of the definition. So for example, type of tax. So we have a taxes may be direct, indirect, and revenue capital, source of revenue, tax avoidance, tax evasion. So this one will give you the definition of the understanding. And remember that more you practice, you'll be more clear. When you do a question first time, maybe it will be not easy for you to understand, but same question, when you do again, maybe you do one question today and tomorrow you do the same question again, you'll feel like more comfortable and it will start making the sense. It will start giving you the logic like, oh, I understand why it's happening. So that's how we can basically do one by one. You see chapter number 1, we don't have anything. Hopefully on chapter number 2, we're going to do some calculation. Thank you very much everyone for watching. Hopefully this video will be helpful for you for your tax study. Thank you.